So here's a riddle. How can a business owner show profit on paper but still run out of money? Or have lots of cash but no profit? Today we're breaking down the difference between profit and cash flow and why confusing the two could sink your business. Profit explained. Profit is your sales minus your expenses. So we're including non-cash expenses like depreciation. A profit and loss tells you how your business has performed financially for a period of time. This is a small snapshot of how the business is going and whether or not you can pay your bills in that time frame. It's a short-term, short-sighted kind of report that you can look at. On the other hand, cash flow. Cash flow is the actual money coming in and out of your bank. It includes things that don't appear on your profit and loss, like loan repayments, drawings, GST, PAYG, things that you just don't see on your profit and loss because they're not an expense. They usually sit over on your balance sheet under assets and liabilities. Cash flow is about survival. You can't pay wages with profit. Let's run through an example. Say you borrow $50,000 from the bank. That's cash in the bank and it hits your bank, but it's no profit. It doesn't go in your profit and loss at all, but the repayments show up on your cash flow. Cashing is going out and it's not an expense. Loans give you cash, but don't affect profit in the way people assume. Example number 2 is depreciation. So say you buy a $30,000 asset, which is a coffee machine. You aren't expensing the whole $30,000 on a profit and loss in 1 year. Because you're using that asset over a period of time, you'll break that down into depreciation and depreciate it over a few years of the life of the coffee machine. So profit looks good. Your depreciation lowers the profit without even touching the cash because you paid for it up front with a loan, and then over time, depreciation hits. You transfer $20,000 out of the company to yourself. That's cash going out, but it's not an expense and it doesn't hit your profit and loss. The ATO sees it as a shareholder loan, and if it's not repaid, it's taxable income to the person taking it. You can drain cash without reducing profit, and this triggers a tax bill, but you've used the cash elsewhere, so you don't have enough tax to cover the bill. Profit tells you if your business model works. Cash flow tells you if you can survive. Both matter, but don't confuse them. Mixing up profit and cash flow is one of the top reasons small business can fail. They think they can spend all this money on things that they may or not need because it will reduce profit and lower tax, when it's not always the case. You want to learn how to track both, and you need to manage both together. So I'll walk through how you can start doing the basics, in our Bookkeeping Boss Academy. So check the link below and make sure you join us. Depreciation lowers your profit without touching your cash. You could look profitable on paper, but the money is already gone. Depreciation is when you buy one big asset up front, say it's a coffee machine, but you're going to use a coffee machine for 10 years. So what we do is we put this over on our balance sheet under our asset account and say we're going to have it for 8 years. We only expense 1/8 each year onto our profit and loss. So 1/8 of the cost of the coffee machine will transfer over to our expenses on our profit and loss. And this shows under the heading depreciation on our profit and loss statement.